Today, emerging pressures on mortgage lenders. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. The US mortgage industry is seeing its first lenders go out of business after a sudden spike in lending rates, and the wave of failures that's coming could be the worst since the housing bubble burst about 15 years ago, according to a recent Bloomberg report. Whilst there's no systematic meltdown coming this time around, because there hasn't been the same level of lending excesses and because many of the biggest banks pulled back from mortgages after the financial crisis, market watchers, though, expect a string of bankruptcies broad enough to trigger a spike in layoffs in an industry that employs hundreds of thousands of workers and potentially an increase in some lending rates. More of the business is now controlled by independent lenders, and with mortgage volumes plunging this year, many are struggling to stay afloat. The non-banks are poorly capitalised, said Nancy Wallace, chair of the real estate group at Berkeley House, the business school at University of California, Berkeley. When the mortgage market tanks, they're in trouble. In 2004, only about a third of the top 20 lenders for refinancings were independent firms, but last year 2/3 of the top 20 were non-bank lenders, according to lendingpatterns.com, which analysed the industry for mortgage lenders. Since 2016, banks have seen their share of the market shrink to about a third from about half, according to news and data provider Inside Mortgage Finance. Home loan application volumes has dropped this year, so many of the so-called shadow lenders will emerge from this slowdown relatively unscathed, but some lenders have already stopped operating or scaled down dramatically, including Sprout Mortgage and First Guarantee Mortgage Corp, both specialised in riskier lending that isn't eligible for government backing. First Guarantee, a company that according to court papers is majority owned by fixed income giant Pacific Investment Management Co., filed for bankruptcy, saying it failed after it made loans earlier this year that dropped in value. It was holding onto those loans until it had enough to bundle into bonds and sell to investors, and it had been temporarily funding them with a line of credit. Once interest rates started to climb, lending volumes shrank across the industry. According to court papers, that meant the company could no longer find enough new loans to bundle or get enough financing to keep operating, said First Guarantee's chief executive officer, Aaron Samples. Firms, included Flagstar Bank and Customers Bank, are owed about $418 million, according to those documents. First Guarantee employed 600 people before it filed for bankruptcy in June and made $10.6 billion in loans last year, according again to court records. Days before seeking court protection, the company fired 471 workers because it couldn't get enough financing to overcome a cash crunch. Independent lenders gained a toehold in the market because banks pulled back so much after the 2008 financial crisis, which started with excessive lending in mortgages. Regulators have often encouraged the retreat, and it's still happening. Wells Fargo & Co., the biggest Wall Street firm in the US mortgage business, plans to shrink its home loan empire. Unlike banks, independent lenders don't often have emergency programs that they can tap for financing when times get tough, nor do they have stable deposit funding. They depend on credit lines that tend to be short-term and depend on mortgage prices. So when they're stuck with bad assets, they face margin calls and potentially go under. Many independent lenders have managed their risks well, and for lenders that work extensively with government-backed companies like Fannie Mae and Freddie Mac, the situation is less dire. They can often get emergency funding from government-sponsored enterprises if they run the difficulty. But those lenders that make riskier loans and work less often with the GSEs have fewer options when they face margin calls. Part of the reason these companies are distressed is because the loans can't go to the GSEs for funding, said David Goodson, head of securitized credit at Voya Investment Management. The options for funding are more limited, which is especially painful when financial conditions are tightening. Many other lenders have seen the value of their loans drop, said Scott Butcher, head of fixed income strategy at Breen Capital, an independent investment bank. The Federal Reserve has tightened rates by 2.25 percentage points this year in an effort to tame inflation, and 30-year US mortgage rates have surged above 5% for government-backed loans. That's close to their highest levels since the financial crisis, from around 3.1% at the end of last year. That's beaten down the value of home loans made just a few months ago. A mortgage made in January and not eligible for government backing could have traded in early August somewhere around 85 cents on the dollar. Lenders usually try to make loans worth somewhere around 102 cents to cover their upfront costs. For a lender whose loans drop to 85 cents, the losses can be debilitating even if they aren't realized yet. On top of that, business is broadly plunging. Overall mortgage application volumes have plunged by more than 50% this year, according to the Mortgage Bankers Association. These business conditions are spurring banks that provide lines of credit, known as warehouses, to make margin calls and cut credit. The warehouse lenders in this industry seem to be extremely on top of things in this downturn, unlike in 2008, said bankruptcy attorney Mark Power, who is representing creditors in the first guarantee bankruptcy. They are making margin calls quickly. Banks have emergency funding they can tap in times of crisis, which can often allow them to stay afloat in hard times, but not always. Emergency financing from the Federal Reserve is usually only available for solvent institutions with a chance of recovering. In the last downturn, so many banks had so many soured loans and struggling assets of all kinds that hundreds failed. Non-banks went bust as well. And at the same time, rental costs in the US are soaring at the fastest pace in more than 3 decades, surpassing a median of $2,000 a month for the first time ever and pushing rents above pre-pandemic levels in most major cities. Increases are particularly steep in metropolitan areas that saw large influxes of new residents during the pandemic, but the rental market is sparing almost nowhere and no one. While the affordability crisis in the US is not new, it has snowballed over the past year as people return to big cities and some areas short on housing supply saw a boom of new residents. Demand for rentals has soared, with many would-be home buyers backing out of the market after mortgage rates jumped this year as a result of the Federal Reserve's aggressive interest rate hikes. Tight inventory is leading to bidding wars, typically more a fixture of the home buying market. Rising costs and a shortage of available units have given landlords the leverage to hike rates at all price points. And the end of the federal eviction moratorium, combined with dwindling rental assistance, has forced people to make tough choices. It's pretty much the perfect storm for renters right now, said Kate Reynolds, Principal Policy Associate at the Washington-based Urban Institute. Those renters and their landlords don't have a place to turn if they're unable to pay the rent. Many renters who typically spend a greater share of their income on housing than homeowners are already struggling to keep up with larger bills at the grocery store and the gas station, thanks to inflation running near the highest in 4 decades. And rent hikes are expected to persistently push inflation higher since leases are staggered and renters face shocks at different times. Shelter costs account for about a third of the closely watched Consumer Price Index, which increased by 8.5% in July from a year earlier, according to the Labour Department data last week. People of colour and those with lower incomes are the most affected by the increase in rent prices since they account for the majority of renters. In the US, about 58% of households headed by black adults rent their homes, along with 52% of Latino-led households, according to a Pew Research Center analysis of census data. In comparison, about a quarter of households led by non-Hispanic white adults and a little under 40% of Asian-led households are renters. Some 54% of renters earn less than $50,000, and the annual median household income among renters is about $42,500. That's below the national median of $67,500, according to Zillow. The problem is being felt around the world too. A recent analysis by Bloomberg found that 19 OECD countries have combined price to rent and home price to income ratios that are higher now than they were ahead of the 2008 financial crisis, indicating that prices have moved out of line with fundamentals. And stresses are showing in Canada too, where Canadian home prices have already started to retreat, dropping 1.7% in July and bringing the cumulative drop from February's peak to nearly 6%, according to the Canadian Real Estate Association. Prices have dropped by double-digit percentages in a number of cities. Now, Canada's 6 largest banks will begin reporting their results soon, and analysts are expecting them to take larger provisions for credit losses than the previous quarter as the outlook worsens for the economy. The variable that most directly affects loan losses is unemployment, and Canada's labour market remains tight, with the jobless rate at a record low of 4.9%. That's translating into a level of loan arrears at the moment of the lowest in 15 years. And while Canada's alternative lenders specialise in customer segments that the big banks avoid, such as those who are new to the country, self-employed, or have a bruised credit history, they have strict underwriting guidelines, income verification procedures, and regulations designed to prevent a wave of defaults, such as the US saw in the 2008 financial crisis, but that doesn't make them immune to potential stresses. For example, at alternative mortgage provider Home Capital, about 64% of borrowers will need to renew their mortgages within 12 months, and some could face payment increases of as much as $850 Canadian a month, stressing their ability to pay. So pressures on lenders from falling prices and raising rates have yet to play out, but I think their card is marked as central banks push target rates higher to try to quell troubling levels of inflation. And the fallout, I think, could be significant, and the non-bank lending sector will, I think, be in the eye of the storm. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.